So in a recent Interest.co.nz article, the ANZ economist team said there are a lot of highly indebted households out there who would be very vulnerable if interest rates were to increase or incomes were to deteriorate. And in terms of investors, it's worth noting that interest rate increase no longer brings a larger tax offset. And there's now a greater chance that interest rates increase could cause investors to sell up. What's going on, guys? It's Brandon here from Mortgage HQ, and in this video we're going to explore the question of, is interest rate going to come up in the coming months? Should you be selling out your property portfolio? What the heck is going on with house prices? Now, I know there are a lot of uncertainty in life, but there's one thing for certain, and that is that you guys smash the like button for the YouTube algorithm. Alright, so first of all, let's go back to basics. What is interest rate? One of the biggest driver for interest rates in New Zealand is the OCR, or official cash rate. OCR is actually a tool for the Reserve Bank to help with price stability and maximum employment. Now, obviously, lower interest rate means higher demand for borrowing and higher demand for goods and services. It's easier for business to borrow money to expand and hire people. Low interest rate means there are more demand for properties and people feel more comfortable to pay for their mortgage. And because debt is so cheap, people decide to go on those holidays or buy those new cars, and there's just more spending in the economy. And when we spend more, there's more demand in the economy, the prices will start to go up because people are not having enough time, they're going to charge more. And when prices go up like that, we call this inflation. So then the RBNZ could then choose to increase interest rate, which will lower the demand for borrowing and therefore lower the demand for goods and services. Businesses now will choose to pay down the debt opposed to borrow more. Households tends to hold back on those holidays, and people are more likely to just keep their head down on their 9 to 5, save some money and pay down their mortgage. Now, a major historic event that we have seen in the past that have dramatic interest rate change is during 2008, where the financial crisis happened in US and affected the whole world. We saw interest rate in New Zealand go from above 10% down to just over 6% in the course of 1 year, effectively dropping by about 50%. And so the reason for this is to actually restore the confidence of the economy, to stimulate more growth in the economy for employment, work, and also spending as well. Now, although the OCR plays a big part in the interest rates for New Zealand, we can say it's not nearly as big as the international market, which is the second major driver for New Zealand interest rates. It is interesting to note that the New Zealand banking system is highly concentrated. Although there are 27 registered banks, the 4 largest banks are all owned by Australians, being ASB, ANZ, BNZ, and Westpac. And they're actually responsible for 85% of all of the bank lending. The 5 New Zealand-owned banks actually only account for about 8% of the lending. So if you guys want to support the New Zealand banks, start using Kiwi Bank more often. Now, on the Reserve Bank website, it also notes that New Zealand's net external liabilities, which is the debt that we borrow, is actually high in comparison to other developed countries. This is actually a result of weak domestic savings. Basically, we're a small economy that save very little money. So offshore funding or borrowing from other places are very important, and it accounts for 2/3 of New Zealand's external liabilities. This creates vulnerability to disruptions in the global financial markets. So what does that mean? We need to pay attention to what's happening with the Federal Reserve Bank, which is the American version of Reserve Bank of New Zealand, as well as RBA, Reserve Bank of Australia, because at the end of the day, New Zealand is a price taker more often than not. But the interesting thing is, on 17th of March, the Federal Open Market Committee announced that it wouldn't raise the Fed funds rate as it did in January 2021. It said it wouldn't raise the rates until inflation is at 2% or above. And that's a good indication of where the interest rate might be heading, is paying attention to those inflation rates. Now, we talked about the two drivers of interest rate. We also have to pay attention to one very interesting word, and that is QE, quantitative easing. In simpler terms, is the government deciding to print more money. Now, at a high level, QE involves buying assets from the private sector. This is actually financed by the creation of central bank reserves. The intention of that is to lower the long-term interest rate, which would then push the demand for goods and services, which in turn boosts the economy activity and employment, which would drive upward pressure on prices. Think of it like the government deciding to buy some properties of businesses. And the businesses have these long-term hold properties. They weren't going to sell because they were getting good rent. But because there's high demand for these houses, the prices go up. It just makes sense to just sell them off and you get a lot more money in hand to use. And that's exactly what a QE is. Now, why do we need to pay attention to QE? It is actually another form of a monetary policy. It's another lever that the RBNZ can use to stimulate the economy. By printing money, it encourages the business and institutions to actually expand, therefore increasing economic growth, employment, and eventually inflation. Now, in the wake of the coronavirus pandemic, the Reserve Bank has actually agreed to spend $60 billion in quantitative easing to prop up the economy. In August 2020, the RBNZ has actually expanded its cap on the quantitative easing to $100 billion over the next 2 years. And just for context, that's about 1/3 of what we earn as the New Zealand economy as a whole as profits, otherwise known as GDP, gross domestic product. Just imagine your household, perhaps you might be making 150K as a whole. Suddenly, the government decides to give you another $60,000 to spend. So you got to spend it wisely. Are you just going to buy the car that you've been wanting to upgrade? Or are you going to invest that in things that is going to actually increase your net worth long term? Now, in theory, when we do a QE, we are supposed to see the economy grow and prices go up. But the only thing that we have been seeing go up are houses and stock. The Reserve Bank has printed $1.2 billion of the first QE announcement. And over the next 4 months, it actually printed another $38.8 billion to buy government bonds. But the problem is that this money is not circulating correctly. The banks have been slow to lend out money to businesses because they were very conservative around COVID and how it has affected these smaller businesses. And so it's not being handed to the consumers, which have not really driven the demand. So in summary, what does this all mean? Will interest rate actually go up? What should we pay attention to moving forward? Now, because of QE, we know there are a lot of money to be spent in the economy. So my personal opinion is that the appetite for lenders is going to ease up over time. After this financial year end, people are going to see their records and the profit and loss are not as bad as the bank initially thought. It's going to be a lot easier to borrow money for businesses, and therefore expansion, and therefore more spending, more demand, and hopefully driving inflation in the medium term. Which interest rate would follow, but that's probably not going to happen immediately. Secondly, with house prices soaring to unsustainable levels in the last 12 months, there was a lot of pressure for Reserve Bank to actually implement new policy such as the debt to income ratio, where they restrict how much you can borrow based on your income, and potentially increasing the interest rate so that it will slow down the housing prices. However, the government sort of stepped in timely to pull them some policies, perhaps not the best, but it did slow down the housing market activities, which sort of ease off the pressure for RBNZ to do something with interest rate or new policies. And I think they're going to sort of hold on to a lower official cash rates. And finally, house prices. Although there's a lot of pullback from investors, they're sort of waiting out to see what happens, there is still a strong combination of low interest rates, money printing, which will drive prices up, and new job opportunities that are coming up, which I believe will actually keep the housing market stable. Until the next video, I'll see you guys again.